Welcome, everyone, to the Daniel Krug and Associates Wealth Management Review, June 11th, 2020. Today's presentation is called What We Understand. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug will be joining me in just a few minutes. He is the CEO and Senior Wealth Manager at Daniel Krug and Associates. Couple of housekeeping items before we get going here. This presentation is for illustrative purposes only. And if you have or need specific information or recommendations, please give our office a call and we will take care of that for you. The webinar today is approximately 30 minutes with question and answer at the end. This session will be recorded. We want to thank City National Rockdale for their contribution and data that they provided and research that they do. Everyone will be muted during the presentation. However, you can use the chat room. Again, the box to the right, you can type in your questions or just say hi to us. Let us know you're on board and watching with us today. Okay, today's agenda, we're going to be covering some major developments that happened this week, a short update on COVID, the reopening and unemployment that's going on. What's the current status of the state's reopening? The markets and investing. And Dan's going to highlight an opportunity strategy so you can really see the dollar impact of doing advanced planning and advanced strategies. And again, we will have question and answer at the end. A reminder of what wealth management means to us. There's basically 5 major components involved in wealth management, and the foundation is investment consulting, that top bar that you see on the screen there. So having a customized, personalized investment strategy is key to growing your wealth. But there are 4 other major areas that we focus in on at Daniel Krug and Associates to really bring home the results that you're looking for. And those areas are in wealth enhancement, wealth transfer, wealth protection, and charitable giving. And you can see all the little categories within each of those major categories that we touch on, and bringing all those together can provide a significant increase to your overall wealth and net worth over your lifetime. Today, we're going to be focusing in on a wealth enhancement strategy, like I said, that Dan is going to be presenting towards the end. So let's get on with the presentation. This week's major developments are unemployment reported a drop in May, which indicated a faster recovery. Dan's going to touch on a little bit more, and there are some questions on that, but the numbers still look much better than expected. States are continuing to move forward in their reopening. Many have entered a next phase of that reopening. On the COVID scene now, while this is important and significant issue that we're dealing with, it seems like we're trending in the right direction. There's no significant issues with reopening so far, and the markets are responding accordingly to the news, the economy, and the policy that has been set out by the government to keep the economy going. So a brief update on COVID-19. Again, this is still a concern, and we have to watch this, but the numbers this week look pretty good. There's still no major increases in hospitalization. So it's flat or declining in most states. We have seen a little bit of an increase in California, 248 new hospitalizations last week. But overall, the data is reflecting a downward trend. And this has been 6 weeks into the start of the reopening. Fatalities continue to decline in most states. There was an increase in Illinois, Michigan, and Massachusetts last week. However, those states, their infection rate is still trending lower. And you have to remember that the fatalities tend to lag all the other data. So that's, we got to keep that in context with the overall trend. Testing has increased significantly since a month ago. If you look at the chart on the left, just back in May, they were testing about 1.8 million per week. Our testing of people has increased to 3.3 million per week. Now we want the number to be a little higher, and we're still pushing for that. But as you can see, we're moving in the right direction, and we are getting closer and closer to what they recommend for full-on weekly testing while we are getting back to work and moving forward with the economy. Also, if you look at the chart on the right, the weekly positive test rate, so the number of people that are testing positive is still continuing to decline. So while the overall news is that the number of testing is increasing, but the positive tests are declining. That's a good sign, and we like that news. So what we're going to do is go on to reopening and unemployment, and I'm going to bring on Dan at this time, the CEO and Senior Wealth Manager at Daniel Krug and Associates, to take us forward in the presentation. So Dan, you want to join us?
Well, good morning, everybody. Thank you very much, Rocky, for that opening. Yep, I'll take it from here.
Okay, I will sign off and be on later.
Awesome. So, I wish I could say I could see everybody, because I'll tell you something, I really, 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 really miss your faces. And like many of you, I miss the hugs, I miss the handshakes, the ability to get together, but things are improving, and hopefully someday we'll get back to some kind of normalcy. When you're thinking about the financial numbers, all in all, the financial numbers are improving, and we are starting to see the recovery. So that's really good news. But although the numbers are encouraging, we're not quite out of the woods yet. So let's talk a little bit about where we are from the reopening standpoint. And we're actually going to go across to the other side of the world. China's is showing a pretty swift recovery right now. This chart here is China's composite purchasing managers index. And as you can see, from history in the past, it was running pretty solidly all the way up until this crisis. It took a major dip in February, but it is coming back very strongly. So what is this suggesting? It's suggesting that recovery can be a relatively quick process. So we'll keep watching that. And when you're thinking about recovery and the unemployment, the reopening is driving more employment. So the U.S. unemployment rate actually dropped down to 13.3% from 14.7% in May. Obviously, there's a little controversy on the numbers that came out. They were so significantly off that they're re-looking at the numbers today. We expect them to be adjusted upward a little bit, but still improved over the May numbers. So when you're looking at this jobs report, we actually picked up 2.5 million new net jobs. And again, that's after May's loss of 20 million in April. So it's significant. We're going in the right direction. We like what we're seeing. So we just need to keep moving that direction. So speaking of reopening, when you're talking about the strong U.S. Response and actually the world response, but speaking specifically of the U.S., our policy is really driving the economic data that's coming in right now. The monetary and fiscal policy actions have been extremely effective, as you can see in this chart. The majority of the jobs, we talked about this over time, over the last few weeks. We expected, based on the numbers, about 78% of the jobless numbers to come back and be very temporary as far as the layoffs go. And that's kind of what we're starting to see right now. So we're seeing that decline. We expect it to continue moving forward. It will be a continued gradual reopening, but again, positive news moving forward. So where are the numbers coming from? Well, when you look at this chart, on the left-hand axis, left-hand side, you've got the number of jobs that were lost in the millions. On the bottom axis, you've got the different industries. So what industry got hit the hardest? Well, leisure and hospitality. Very, very abrupt stop in that industry put a lot of people on unemployment. But when you're looking at this chart, the black is the April 20 numbers and the blue is the May 20 numbers. And when you're thinking about leisure and hospitality, it's actually leading the way coming back. So every one of these areas, retail, education, construction, manufacturing, professional, and business, they're all moving positive. The only one that is not at this time is state and local governments, which do remain a bit of a drag. And part of that is budget issues. I mean, they've spent a lot of money. We're going to be moving forward, but at the end of the day, they're going to be lagging behind, I think, for a little bit of time here. So let's move on to markets and investing. And one of the things that you have us here for is to make sure we're watching your money. We're watching the markets, really putting into place strategies that can put you in a much better position. And believe me, we are watching these numbers daily and really looking at the data to see which way we should be moving. And we will continue to do so for you. So let's go on to the financial speedometers. Again, what we're going to look at first is the credit market conditions. And with these speedometers, they're speed dials per se. The colors are typically going to be red, yellow, green, green being the best, red being the worst. And you've got hands on these. The dotted hand is the previous week's position, and the solid is where we are today. So you can see the credit market is improving. It's gone green this week. Monetary policy has been good all along. So, it is what's driving the credit and the liquidity. So think of it this way. Your liquidity is really the ability to be able to access money if you need it from a company standpoint. And again, that has moved to the positive side as well. And that is largely due to the Federal Reserve's response and our federal government. So not worried about the credit markets at this point. However, saying that, I would say, where's the yield when you're looking at returns relative to income-based portfolios? So if you were used to collecting a check out of your portfolio based on an income bond portfolio, you can really expect that to decrease over time here. And it has actually since 2012, when the secular bear market for bonds had begun. So if you don't need money and you just want the safety, it's fine to be in those positions, but you will not be able to expect the same returns. Now, if you're someone who says, yeah, but I do want the extra income coming in, then at that point, you're going to have to look at shifting the portfolio a little bit tactically to be able to get those returns. So when you're looking at this chart here, it shows you where the returns are going to be coming from it really moving forward, where they are today and moving forward. So you've got U.S. high yield, you've got senior secured loans, which are pretty decent, and you've got emerging markets. Again, each one is going to require a little additional risk, but if you need the money, we'll work it into your risk portfolio to make it work for you. So that's the credit and the bond market. Now let's move on to the financial speedometers. From a financial speedometers, we're going to look at the equity markets and what condition they're in. Well, everybody knows that the stock market just doesn't seem to want to quit. It just keeps moving higher. Now, the last 3 days, we're seeing a different tone, but ultimately, the market has moved up in such a dramatic fashion. No one really expected it to be where it is today. So why is it there? Well, the reality is when you go over to the right side of these indicators, you've got valuation. If you looked at valuation, you'd say, well, wait a minute, that means the stocks are really high, but we're not getting the earnings. And there's where the rub is. Most institutional money managers are still holding money on the sidelines right now because they're concerned that the valuations are really high. That's why this dial is red. When you go all the way over to the left side, you're looking at the fear indicator, which is also red. Now, keep in mind, the fear indicator is a contrary indicator. What's happening is the stock markets and people in the stock market are rather exuberant. Money managers don't like exuberance and very high PE ratios, because that can be a recipe for another downturn in the market. So let's take a look at where we are from a price earnings ratio on the S&P 500. So when you're looking at this chart, you've seen it multiple times. What you're seeing that's changing is what the current price earnings ratio is. And it has been inching up ever so rapidly, actually, over the last few weeks. And right now, it's currently at a 22.33. And when you look at that red line at the top going across, you'll see that we haven't been here since 1999. And we certainly understand what happened in 1999 or the subsequent year, 2000, when we had a recession hit at that point. Do we expect the markets to go down as far as it did at that point? No, we don't. But we are expecting a retracement here. So the price earnings ratio is just really on the high side. Most institutional money managers want it in the blue or green zone because that's where they know that they've got a lot of room to run in the rest of their portfolio. So that's where they will be adding the additional funds in the market and getting fully invested. So that brings us to this chart, where we are today. When you look at this chart, you can see that the S&P 500 has really moved up dramatically from where we were in the beginning to where we are today. It's been a steady and rapid increase, but we're kind of hesitating in the market right now. I've talked about this gap over here before. It'll be interesting to see how that unfolds in the future. Again, most indexes, most stocks don't like gaps in the market. They tend to fill them at some point. What could that mean? It could mean that it goes up, hits this number, fills it, and then it comes back down again. Would it surprise me if it started happening during the earnings season, which starts in July? No, that wouldn't surprise me at all. And that's actually one of the catalysts that we're looking at to see where it's actually going to go from there. And again, we'll be watching the data as we're watching the technicals as well. You know, some clients might ask, well, what if it just keeps going up? That could happen. And if that's the case, and we've got money on the sideline, we're going to have to get it invested at some point. But we just don't think that's the possibility here. We believe it's going to be retracing, as well as the economists and the institutional money managers we work with. So let's talk about a couple bear markets that we've had in the past. We'll look at October 82 and May of 2009. During that period, after the decline, the market again made a rapid advancement, and many of those looking at it know that the reason that happened was because of policies that were put into place. So when you're looking at this chart, in 82, there was an interest rate reduction policy to get things spurred. In 2009, it was a monetary and fiscal stimulus. Same thing in 2020, what we're going through today, but we're adding reopening an economy to that. The area that I would really like to have you focus on is this right here. When you look at the S&P 500, the next 5 years, the annualized returns, they were 12% and 16% respectively. So we're looking at the market over the next 5 years, once we do get fully opened up, to be rather robust. Maybe not as much as it was over the last two bull markets, but still something that is going to be certainly where we want to be invested, and that would be in the market. If you look at this chart, it indicates where the returns were from a yield standpoint from 2009 to 2019, as well as stocks, and what they're actually forecasting moving forward. And you can see there is certainly a reduction in every area, the stocks, the bonds, and in blend portfolios. And some might look at that and say, well, shoot, that's not quite the return I would like to see. Well, at the end of the day, when we're looking at managing portfolios for clients, we absolutely have to be tactical in these days. It's not to say that there isn't a place for structured portfolios. There is. But if you do not have a tactical component to what you're doing, I think you're going to be left behind. So that is where our focus is. That's where a focus is with our institutional money managers. And when you're looking at the returns, one of the places to boost your return really is alternative investments. Will they be down a bit from 2009 to 2019? Yes, they will, but they're still going to be higher than your typical high dividend stocks, emerging markets, or high yield bonds. So it's a way to get income coming in and boost the yield a little bit at the same time. So that kind of brings us to the opportunities. And if you think about the opportunities out there, we've got them. The market is in a position where we believe, again, it's going to retrace, but it's up higher than anybody was really anticipating at this time. So when you're looking at investment strategies, and equally as important, the wealth enhancement, we're implementing strategies that are going to enhance your returns long term. So these are the 5 strategies that we've got ready to activate or have already initiated at this point. Over the next few weeks, we're actually going to highlight each one of these strategies. And this week, we're going to be looking at strategy 3, draw and let heal. So let's take a deep dive into this. If you have an investor who has a $500,000 investment, and prior to the stock market, they were thinking, hey, everything's going great. I've got $500,000 in the account, keeps going up. And then all of a sudden we get this crisis. The account drops 20%. Well, at that point, a 20% loss brings them down to about $400,000 in the account. That's a decrease of $100,000. Now, if the account dropped $20,000, the question is, how much of a return do we need to get back to the previous level? Well, there's a calculation for that. It works like this. You take your value loss, you divide it by the current downturn value. In other words, what's the value in the account now? And then that equals the percent needed to break even. So in this equation, it's the $100,000 value loss. It's the 400,000 downturn value. So you divide the 100 by the 400, it means you need a 25% return. And some might be saying, well, wait a minute, it only went down 20%. Well, that's true, but we have less money in the account, so we need a greater return to get it back to even. It has to work a little bit harder getting back up to where you were before. So there's another question that comes out. What if you're taking income out of that portfolio during the downturn and the recovery? So it would not be uncommon for our clients to take, let's say, $5,000 a month out of the account. And if the downturn to recovery lasted 6 months, that's a $30,000 withdrawal amount out of the portfolio. Now, if you go back to the original equation, and that was your pre-cash value was $500,000, the account drops 20%. You now have $400,000, but you took out $30,000 from the account for your income. Well, that decreases the account to $130,000. So it's a lot less than it was if you weren't taking the income. So in this scenario, now we've got a $130,000 drop in the account. We divide that by the balance, 370. Now we actually need a 35.1% return to get back to even. You can start seeing that when you're pulling the money out, it's making it more and more difficult to get the returns back to where you wanted to be or where you were before. That is why in the 2008 crash, so many people outside of our office, so many people had such a difficult time getting back to even, and many of them didn't get back to even until 2015. Again, that was not the case with our clients, but you can see how if you didn't have a strategy in place like this, how much more difficult it is to get you where you want to go. Now, there is a question, well, I still need income. It's not like I can stop living, right? Well, we have a solution for that too. These are solutions that were put into place years ago for such a time as this. So what do we have here? We've got overfunded cash value in our life insurance policies. So that's one place to access it. Those who could not qualify or do not have a policy like that, we also have home equity lines of credit to access. To go even further, there are many clients that have cash in the bank that could be enough to sustain them through this crisis. That's where we want to be pulling the money. So if you do that and you left that $30,000 in your account, that $30,000, if we have a 25% rate of return, that's going to give you a $7,500 gain. So keep in mind, if you took the $30,000 out, you never would have gotten that gain back. And that's what's needed to help us get back without needing such a great rate of return. So I know I've got a lot of very, very intelligent clients out there. So some of you are asking this question: isn't there a cost associated to the cash value I have to pull out or the home equity line of credit? And the answer is yes, there is. But let's take a look at this. What if we took the $30,000 out of either of these programs, and let's just assume there was a 6% yield on those or interest rate on it for 6 months? Well, the cost of having that money out of those accounts would be about $1,096. Okay, let's take that and put it into the equation here. You have a $7,500 gain from the investments. you take away the amount of the cost to borrow the funds, that still leaves us with $6,400 net investor savings. So that's a big deal. That's more than a month's worth of income that the individual would have been taking out of the account. And I think anybody would say that makes a lot of sense. Let's take it a step further. What if you took that 6,400 and you got a 7% return over the next 20 years? Well, ultimately, that's going to give you about $23,000. Again, not chump change. Well, let's take it a step further. What if we have another 2 or 3 recessions? Well, 2 more recessions means that our net savings over time is going to be about $70,000. Again, that's a lot of money. That's what these strategies do for you. They enhance the returns to allow you to build and keep the money that you need for the future. So these strategies, do they take a little bit of work? Yes, they do, but I'm sure you can see that the money is well worth it, the returns. So that kind of brings us to our next slide. One of the things that we do these reviews for, or these weekly reviews for right now, are to give you updates on where we are in the strategies. So we do have some clients, some of you who are watching right now, that actually was doing a Roth conversion either prior to the market crash, or we actually executed somewhere on the way down. Well, at that point, we didn't pull any taxes out because with the market down, we did not want to do that. So right now, with the markets back up, we're actually going to pay the taxes on those Roth conversions at this point. Same thing is going to happen with life insurance. In other words, we suspended paying the life insurance premiums on any policy that needed to have a premium during this downturn. Now that the market's up, we're going to look back. We're going to grab every client that needs a premium paid. We're going to go ahead and make those payments this week and next week to get them up to date. So that's kind of an update on the strategy. We have not implemented any risk up strategies yet. Any cash that we have in the accounts right now that are waiting to be deployed when the market comes back, we haven't done that yet. We're still waiting for the right time. And same thing with all the Roth conversions that we have set and ready to go. They're just waiting for us to pull the trigger. So that gives you a little bit of an update of where we are today. So when we're talking about these reviews, our communication to you is key, and we want to make sure that we're assessing the situation, actively managing what we are doing for you and your accounts. You know, you need to be in the best position possible in order to ride out the storm and to be ready to capitalize on any kind of future opportunity. So that's what we're looking at. That's why we do these reviews. That's who we are. So that kind of brings us to the questions and answers. So Rocky, I'm going to pass it back to you.
Okay. Well, we do have some questions. And let's start. The first question is, did I hear correct that the required minimum distribution will not be enforced for 2020, for this year?
Well, to answer that one, the answer to that is yes. And if you think about it, if you don't have to do a required minimum distribution and you were in a Roth conversion strategy already, in other words, our Roth conversion strategies tend to go over multiple years, you might want to look at taking the money that you were going to take out because you were going to be required to take the distribution. And since your income level would stay the same, you might determine that it makes sense to convert a little bit more into a Roth. Because again, if you converted that amount that you were going to take for the minimum distribution, you're going to pay the taxes on it. But the good news is Now it's in a Roth account. So as it grows forward, henceforth, you will have a tax-free growth and tax-free distribution on that money. So again, another tweak on the Roth conversions, but this is good opportunity to do it. But I would say this, I would wait until the market retraces before you do the Roth conversion if you choose to do that.
Very good. Another question from Larry is, you mentioned alternative investments. What are some examples? So I'll take that one. Basically, when we're talking traditional investments, we're talking stocks and bonds, right? The stock market, the bond market. But when we're talking alternatives, we're talking about things that are outside of those markets, which are things like commodities, private equity. And one of the things that we really get our clients involved with higher net worth clients are those private equity, things that you can't get on the open exchanges. So that's a really important opportunity for clients, that you have the ability to get into a company, a startup, as an investor, but it's not a publicly traded company. Other types of alternative investments are hedge funds. They have different types of strategies. Sometimes they're related to the market, and sometimes they're related to things outside of the market. And another strategy that we use a lot is real estate ventures. So again, these are not traditional stock and bond portfolios, but they can enhance significantly, as Dan showed you on that one slide, the return on an overall portfolio. Also, it helps you reduce your overall risk to be in assets that are outside of the traditional stock and bond portfolios. So those were a couple questions. One other thing that came up is income portfolios. Dan, if you could just touch on that again. You're talking about needing to take on a little bit more risk to maintain your yield. So could you just say what's changed in the strategy again, to remind people that it's not just going out and getting a high return in bonds, but we're going to have to add other types of income-driven positions to keep that yield up?
Right. So with most of our clients don't have necessarily a bond income portfolio, although there are some that do. The traditional bond portfolios are going to give you around a 2% yield over time. And since we are in a secular bear market for bonds, we don't expect that to change anytime soon. So in order to enhance the income in those type portfolios, that's where the alternatives, or going to a higher yield or senior notes or of different type ventures like that, to actually be able to eke out a higher rate of return. Now, again, in many cases, that might require a little bit more risk associated with it to maintain the income at that level. Now, that being said, most of you know that we don't do a lot when it comes to the bond portfolios as a income driver. A couple reasons for that. One is that your dividends that come off of a bond portfolio, if not in a retirement account, is going to create ordinary income, whereby capital gains is going to create a much lower tax rate because of the capital gains rates that you have. Again, another aspect of the wealth management and enhancement to allow you to keep more of what is yours. And the reality is, with the amount of money our government has spent, and rightly so, they needed to do this, but the amount they've spent, you know, if we were worried about having to pay higher taxes on debt before, what are we thinking now? And this is where these strategies, these wealth enhancement strategies, the tax mitigation strategies, are going to be critical, because they're going to allow you to keep more of your money. So that's more of the way we focus on it. However, we do have some bond portfolios out there for clients. Rocky?
Okay, very good. Well, that seems to have taken care of the questions. I want to thank people for participating today, jumping on board, asking questions. They were all really good questions. And we look forward to serving you guys in the future, seeing you on future webinars. So there's no need for you to worry. You take care of your family, and we will take care of you. So we're ready for 2020 and beyond. And again, thanks for joining, and have a good day.
Bye-bye.
Bye-bye.